Bias number 4 is a framing bias. So this means that we make decisions based on how something is presented to us. So an example of this is a really straightforward example, but say you go to the shop and you're picking out a yogurt, and one of the yogurts says that it's 90% fat-free and the other yogurt says it's 10% fat. Which one are you choosing?
I don't know.
What? You're not going to pick
I'm not really a yogurt person. Can you pick another example? No.
You're not going to pick a 10% fat yogurt. Right. Well, both yogurts are identical is the answer. So they're exactly the same, but obviously people are going to be more inclined to pick the 90% fat-free instead of the 10% fat yogurt because that does not sound good.
Welcome to Checks and Balances. This is The Takeover, and this is Jess and Michaela back with another episode.
We are talking about behavioral finance. So 5 important biases that we should all take into consideration in our day-to-day life and in our finances. And the reason that this episode has come about, first of all, I did a psychology degree, so I feel very interested.
Fancy.
It's not fancy. I'm very interested in this stuff personally. So when it came up in my studies, my recent studies, I was super stoked about it. I just think it's super interesting. I think it's very applicable to everyday life and important for people to be aware of. So we've all heard of a bias. We know what a bias is. It's like a tendency to think or behave in a certain way. Usually you're not conscious of why you're behaving in that way. So it's not something you're super aware of. So that's what we're going to try and fix today, is bring awareness to the bias.
Okay. I can't wait to find out what bias I have.
Yeah. Well, all of them, probably.
Rude.
We all do. Cool. So we're going to talk about 5 different ones. Something that I'm not sure of, if it's biases or biases.
Ooh.
And I tried looking it up and I'm still not sure. So
I think you should just go with your gut on this one. I won't judge you either way.
Thanks.
Someone in the comments might
if
judge
everybody
you,
else could please not judge me as well, that would be really nice. Okay. So the first one is called an anchoring bias. So that means that we have an irrational bias towards an arbitrary benchmark figure, which sounds confusing.
Can you say that in like normal
people
people terms?
So I have an example, but it basically means that we put too much importance on the first piece of information that we receive, and give it too much weight when we're making a decision.
Right.
So an example of this would be a Briscoe's sale.
Love a Briscoe's sale.
I mean, there's always a Briscoe's sale. You go to Briscoe's and there's a vacuum cleaner, and they're telling us that this vacuum cleaner was $1,000 and it's on sale for $500. Now, what do you think the anchoring piece of information is in that scenario?
Obviously that it's on sale.
Well, maybe for you.
I love a sale.
The anchoring point of information here is the $1,000. So we're giving the $1,000 too much importance. Are we looking at the brand of the vacuum cleaner? Are we looking at the quality of it? What are other shops selling that vacuum cleaner for? Basically, the question is it actually worth $1,000, or are we just anchoring on that piece of information?
Right.
Because they're selling it to us for $500. So we need to look at the wider context of this information that we're being given and not put too much importance on that $1,000 point of information.
I feel like I fall for this all the time.
We all do.
Specifically with the Briscoe's sales.
What are you getting at Briscoe's?
I just really like Briscoe's, okay? I like home stuff.
Right.
And David is always having to talk me out of buying stuff because of this exact reason.
Yeah.
Like, in no world did that one singular frying pan ever cost $250. But now that it's $50, I'm like, well, this is a fabulous deal.
You're getting a bargain.
But like you said, it probably didn't cost that much in the first place. And
You're
I can
anchoring.
probably get it somewhere else for a better price.
Right, if you shop around. So the example in finance, now that we sort of understand what this means, the example in finance would be that you hear, say, a stock or a share was priced at $100 last year, and you anchor to that piece of information. And now the price of that share has dropped to, say, $80. And you're thinking, oh, it's gone down in price. It's a good deal. It's a bargain. It's a sale, like, on this share. And you might buy lots of those shares thinking you're getting a good deal, but you're not taking, because you've anchored to the $100 price point, but you're not taking into consideration maybe that company lost a bunch of their contracts. Maybe they've had a change in management. maybe the market's not performing in general anyway. There's like a number of things that could be contributing to this drop in price that you're not looking at.
So are you then thinking, if you think this way, that definitely it will come back up to that $100 point again?
Exactly. Yes. So you think you're getting your bargain. So what to do about it? When we come across these situations, like first of all, you're now aware of an anchoring bias, so you should be able to recognize when it's happening. But how to get around it is to define clear and objective criteria before decision making. So you want to go out and buy a vacuum cleaner or a frying pan. What are you looking for in that vacuum cleaner? What are the features? How much are you willing to spend? All of these things, like define that criteria before you go out and make the decision. That does really help to keep you on a clear path. And gather data from multiple sources. So don't just go to Briscoe's, go to Farmers as well, go to the warehouse, go have a look online, gather data from multiple places. That's going to help you make a more sound decision.
Right.
And actively challenge that anchoring piece of data that you've received. Think, okay, is this vacuum cleaner actually worth $1,000? Is that share actually worth $100? Challenging that is going to help you clear things up.
I feel like I'm not really a stocks person, so I could be wrong, but I remember during COVID times, the price of Air New Zealand went down quite a bit because, people weren't flying and a lot of people were buying it up because it's Air New Zealand, so it's got to be good. But it actually took quite a long time for it to get good again.
Yeah.
And I remember seeing a bit of discourse around it, I think on Reddit. Just that, people were saying, I had bought all this Air New Zealand stock, but it's been a year and it still hasn't, it's either gone down a bit more. There's been not really any change.
Yeah.
So I feel like that's maybe an example.
It could be,
especially anchoring to the fact that like the brand rather than the price point, like, Air New Zealand or whatever other big companies we have, you're thinking like, it's got to be good because it's that.
Yeah, you've anchored too much to it. And it could bounce back over a long period of time because you're taking a long-term view. It could well come back. But the whole idea is that you're giving too much weight to that one piece of information rather than looking at the whole picture to make your decision. That's our first one. The second one is a really interesting one. So we experience loss more severely than the equivalent gain. So this one's called loss aversion. What that means is that we value gains and losses differently. So you are going to feel the pain of losing something more severely than if you were to feel the gain of something equal to it. Right. So that sounds a bit confusing, but an example in everyday life would be, say you found $20 on the ground. You're like,
I have done that before.
Have you?
It's a great day.
How good. You're like stoked. But you're kind of like, oh, cool. I found $20. Nice. If you had $20 in your wallet and you've lost it, you feel that pain is more painful than how excited you are to find the $20 is the concept.
Interesting.
Yeah. Do you feel that?
I feel like that makes sense. If I lost $20, I'd definitely be gutted.
You'd be more mad than you were happy that you found
But if I found $20 in the same day, I would probably be like, no, I think I would be super stoked, even though I've come out the same.
You're net back at zero.
Yeah.
Yeah. So the way that this applies in investing, again, is it's a mental thing. So say you've invested $1,000 and your investment drops in value to $900. You are going to feel that pain more than if the investment rises to $1,100. Right. So even though the difference is still $100 each way, you're going to feel the drop more than you feel the increase. So it's another important one to be aware of. Obviously, as we know, markets, they bobble up and down all the time. A good example is with your KiwiSaver, for instance. Yeah. Your KiwiSaver is not a savings account. It's going to move up and down as the market moves up and down. So being aware that you as a human being are going to feel the loss more than you feel the gain.
I always say to my friends, like, don't look at your KiwiSaver balance because it doesn't actually matter right now.
It's
and if you see that it's gone down, I had a friend, I think it was last year, say, my KiwiSaver balance has dropped quite a lot. Do you think I should move it to a different provider or change the fund?
Well, maybe.
And I was like, no, this is just what happens. It's a long-term investment and it's going to do this.
Yeah.
And just don't look at it if you're the kind of person that will, get stressed out by seeing those little drops.
Exactly. And the worst thing that you could do, like you say, when the market drops or your investment drops in value, I mean, obviously this depends on the investment, but say we're talking about KiwiSaver. Say you're in an aggressive fund, say you're 30 years old, you can't touch that money. If you've already bought your first home, you can't touch that money till you're 65. If the market drops, your investment drops. The worst thing you could possibly do in that situation is panic and move it to a cash fund because you've crystallized the loss. The loss has become real. It was just happening on paper before and you've locked it in. Mm-hmm. So being aware that you're going to feel that pain more than if you watch your balance go up is an important one. And the best way around it is to actively consider the upside and the downside equally.
Yeah.
So think if this was happening, like, when your investment goes up, think, well, if this is happening the other way around, how would I feel? If it's going down, if this was happening the other way around, how would I feel? Flip it on its head and try and give yourself some perspective as to what's happening is kind of a good way to get some clarity.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
We had this happen kind of recently, I think, in our last episode when I was talking about first home buyer woes kind of thing. And I was talking about my cladding on my house being not great.
Yeah.
So we were trying, the reason we found that out is because we were trying to sell the house. And we really went back and forth on if we should sell it for, as we know, the market is down at the minute, if we should sell it for that much lesser price and just cut our losses and walk away from it. Yeah. But ultimately we decided not to because, as you said, and this is what David said at the time, was if we sell it, we are locking in that loss. Whereas if we just stay put for now and ride the market out, then we're going to be a completely different situation.
Yeah. And you really feel the pain of that loss more than if the market was up and the house had sold for that much more.
Exactly.
Interesting. But yeah, just something to be aware of, like we say. And the third one is an overconfidence bias. So I think this is a very, very common one. It can affect everybody, but, fund managers, traders, investors, financial advisors, they could all be affected by this overconfidence bias. And it's quite self-explanatory. It just means that you believe that you're more capable than you actually are. And this might stem from you've had some early success in the game. Maybe the market was doing really well. You picked a couple of good stocks or you invested in a couple of good funds and you nailed it. And now you think that you've got some special insight or ability to be able to continue to do that going forward, which is not true.
Yeah. Interesting.
So a good example of this in everyday life is driving. And we live in Auckland, so we know that there's some overconfident drivers around us. There was a study in the US, they polled drivers and 93% of them said that their driving abilities were above average. So 93% of people can't be above average. 43% of those people are incorrect. But the problem with overconfidence is that, think about driving. Overconfident driving is that it can be dangerous and you can crash, you can cause harm to others, that kind of thing. And there's a very fine line between being a confident driver and an overconfident driver. So much like in finance, fine line between confidence and overconfidence. An overconfident fund manager, for instance, might make decisions that are not sound because they think that they're better, they think that they know more, they think that they have more control than everybody else, and that's not necessarily the case.
Yeah. I feel like that's also, we have a few boys in the office do sports betting.
Oh my goodness.
And it's like you win a few good bets.
That's the best example.
And then all of a sudden you're like rock star gambler. I'm going to win every race, every game. Like come to me for the hot tips.
Yeah.
But as soon as there's, they lose one, it's, I don't know what happened there.
Gosh. Yeah. Don't go near them. So overconfidence can lead to costly mistakes, especially when the market doesn't behave as expected, which is all the time.
And we can never predict it.
You can never predict it. You've got no control over it. So another thing to be aware of, and the best way around this is to seek feedback from other people, especially people who have different opinions to you. So perhaps the boys, when they're making their sports bets, can go around and ask each other, like, what are you thinking? What are you thinking? It gives them some perspective of their overconfidence bias. Bias number 4 is a framing bias. So this means that we make decisions based on how something is presented to us. So an example of this is a really straightforward example, but say you go to the shop and you're picking out a yogurt, and one of the yogurts says that it's 90% fat-free and the other yogurt says it's 10% fat. Which one are you choosing?
I don't know.
What? You're not going to pick
I'm
a
not really a yogurt person. Can you pick another example? No.
You're not going to pick a 10% fat yogurt. Right. Well, both yogurts are identical is the answer. So they're exactly the same, but obviously people are going to be more inclined to pick the 90% fat-free instead of the 10% fat yogurt because that does not sound good. So in context of an investment, a financial advisor or somebody might be pitching something to you for an investment, and they might say, this investment has a 70% chance of doing X, Y, Z. Awesome. On the flip side of that, you could say this investment has a 30% chance of doing the opposite, 70% chance of success, 30% chance of failure. Depending on how that investment is framed to you, it's going to affect your decision whether to buy in or not, right? So that's that one. Again, I think the way around this is to flip it on its head. When information is being presented to you in a certain way, turn it around and go, okay, I'm being told this. If I flip it on its head to give myself perspective, how do I feel when I look at it from that angle? And in doing that, try and remove any emotionally charged language, take all the emotion out of that decision. And that way you're kind of looking at it from all angles, giving yourself perspective, and can make an informed decision.
Yeah, I guess like a 30% gain, like chance of a gain, sounds pretty good to me. But if you tell me there's a 70% chance of a loss, then I'm probably not going to choose that.
Exactly. So framing's a really big one. And this can happen in all walks of life. But you know, when it comes to financial decisions and you're taking advice from an expert, you know, everyone falls prey to it. So does the expert. So that's why it's important to be aware of it.
Do people ever present, I mean, this is probably not good, but do people present things, if you're the fund manager or someone trying to sell a stock or an investment to someone, present it in the way that sounds more attractive just to get the buy-in?
I think somebody who's working on a product like that is always going to want to present it in the best light.
I suppose in marketing, like if we take it away from finance, if you were just marketing a product, you probably would go with the more enticing statistic because that will get people to buy it.
Of course.
Like the fat-free yogurt.
The yogurt, I was going to say the yogurt manufacturers obviously are going to want to present their product in the best possible light so that people buy it. And that's why it's important that it's up to you to be aware of this bias and frame it differently for yourself because the people selling you a product are not going to do that for you.
Yeah. Damn yogurt sellers.
Exactly. Cool. Okay. So the last one I want to touch on is called recency bias. And this actually happened to me last night because I've been telling my girlfriends about this episode and they couldn't believe because the recency bias actually came up in conversation. So this is when we overweight new information or events. So we give too much importance to the last thing we heard rather than looking back through the information that we have over the long term.
Okay.
So the example of this that happened last night is that we're going to a bottomless brunch today and we're going to Jungle 8, which I'm really excited about. I've been to Jungle 8 and Lucky 8 a handful of times and had a really good time. However, my friend went to Lucky 8 on Wednesday and did not have good service. Like every time I've been there, cocktails have been Have you been here?
No, I haven't.
Oh,
but I want
gotta
to.
Go.
Well,
so
depending
good.
on how this conversation
Well, yeah, exactly. So whenever I've been, the cocktails have been like you order one, it's there within a couple of minutes. They're so good. The food's good. Great time. And she said she went and waited 35 minutes for a cocktail. And so now I'm really worried about today going well because I'm thinking I've planned this for her birthday. And if I'm waiting 35 minutes for a cocktail at a bottomless brunch, I'm not going to be very happy.
Yeah.
But then the girls were like, this is the recency bias. It's happening. Like you've been to Lucky 8 and Jungle 8 a number of times and it's been fine. So that's my everyday example of recency bias. Does that make sense?
That's interesting. No, that does make sense. Or it's kind of like when you book a trip somewhere and someone went there a few months ago and they had a terrible time or the weather was bad or whatever.
Yeah.
And then you're thinking, oh, well, should I still book this trip somewhere because that person had a bad time, but meanwhile, another person had a great time in the same time
Or like
frame?
10 of your friends have had a great time at that place. It's just that one recent person didn't.
Yeah.
So, yeah, I think the example in finance is when you're investing in a market, the way that things are now, you think it's going to continue that way forever. So if the market's going down or if it's not doing well, you think, oh, it's not going to do well forever. And we know, like looking over history, that that's not the case. Equally, if the market's performing really well, you think, oh, this is going to keep going in that direction forever. Also not the case.
Yeah.
So it's important to look back over all the data that you have long term, not give too much importance to what's happening now or what's happening in the most recent moment, because that's not what's going to continue in future necessarily.
I feel like that's huge right now for people that are buying properties because, you know, things look pretty grim out there, but this isn't a permanent situation. And we always say on the mortgage team, like the time is always now, because whatever is going on in the market, it's not going to be permanent. And like, just get in, just do the thing and take the action. Yeah. Because, you know, houses are on sale right now. Buy them.
Yeah. It's, what do you guys always say? The right time to buy a house is when you need to buy a house, or when you want to buy a house.
Something like
just
that.
Just buy it now.
Just do it.
Yeah. So the workaround for this is you need to actively consider long-term trends and information you have access to. I know that Lucky 8 and Jungle 8 have been good in the past because I've been there. And I know that Zoe had a bad experience on Wednesday, but that's not for me to worry about tonight being a massive failure. Right. So much like with your investments, just because something's happening in this moment, don't fret, don't give too much weight to what's happening right in this moment. Think back through time, think back through the information you have access to, and make the decisions based on that. So the key things I want to leave you with today. The first one, education is key. We always say like knowledge is power. So bringing awareness to these biases, not
that's
sure.
what you want to go with,
will be the first step to overcoming them. Number one. Yeah. Number two, slow down your decision making. So rushed decisions are more likely to be affected. You're more likely to bring emotion and bias into it. So whether it's developing checklists, criteria to slow yourself down and make sure you're making sound decisions, that's another good one. Number three, have predefined goals and strategies to prevent emotional reactions. So having a clear set of criteria when you're making a decision is really going to help slow things down, remove the emotion. Like when you go to Briscoe's to buy that vacuum cleaner, what do you want it to have? When you're making an investment, what are the things you need it to have? What are the goals you want to achieve with it? Right. Have that predefined. Number four is seek advice and opinions from multiple people and places, especially those that might think differently from you. So that's an important one to give you perspective, to avoid bias, but there is also a balance between doing too much research and taking action. Like we know paralysis by analysis. We don't want to do too much of this. So there's a fine balance, but, you know, something to take away from today. So to wrap up, thank you so much to Partners Life for sponsoring this episode. Don't forget to like, review, and subscribe, and we'll see you next time.